Hey everybody, this is Lorelia. I'm doing a quick YouTube live. Wanted to discuss an article that I read online, and it has to do with credit and cryptocurrency. Now, just so cryptocurrency is something that is widely talked about today. And this video is not to talk about cryptocurrency. I feel like it's enough information on YouTube that discusses what it is, because it's more than just Bitcoin. It's really a discussion about an article that I was saying earlier when I first started this live, what I read online. So, understand that I am going to discuss um, the credit piece of it. And like I said, this is not to talk about cryptocurrency if that's something that you are involved in, you are doing. It is to I want you to think about the information that I'm sharing with you. But if you look behind me, you will see this is the article. It says three major banks. It actually came out with yesterday, because today is the 5th. Three major banks confirmed that they won't allow cryptocurrency transactions with their credit card. There was another article that I found, which was right here. Lloyds Bank. If you're not familiar with Lloyds Bank is pretty much the Bank of America, the JP Morgan of the UK, of Britain. So there's no Lloyds Bank here in America, but like I said, it is the Bank of America, the JP Morgan of the UK. And once again, I'm going to first start talking about the Lloyds Bank. So in this article, and I'll put links below if you want to read it. But it said Lloyds Bank, Bank of Scotland, Halifax, and MBNA, even though we do have MBNA over here in the US, are not accepting credit card transactions involving cryptocurrency. So what you may not know, and this is stuff that I've read, early part of the summer in 2017, there was a big I'm going to call it a bubble. It was a big discussion, not even a discussion. It was basically um, people who were running to invest into cryptocurrency. It didn't matter if it was Bitcoin or what have you. They were running to it because of the rising price, which at that time was, of course, Bitcoin, which is the most common cryptocurrency. So what was happening, based on articles that I read, people were taking advances off of their credit cards to invest in this, if it's a commodity, I don't know, in cryptocurrency. Well, according to, now I'm going back to the Bank of America one, if you see behind me, according to these articles, they are stopping it. And like I said, this is not a discussion about cryptocurrency, it's to make you think. Because I always say that the people who lend you credit, now going back to the article that you see behind me, Bank of America, JP Morgan Chase, and Citigroup, these are the three largest lenders that when it comes to credit. And I always say that they know more about your financial habits than you know about yourself. That's why I say, credit and debt is a $1 trillion industry. I did a video on that, a YouTube live, showing you the US debt clock. And so with that being said, they understand their financial statements. Now, my question to you, do you understand your own financial statements? And what do I mean by that? See, when a bank issues you credit, it is debt to you, but it's income to them. When you pay, I think recently I did a video and someone made a comment about, do lenders allow you to make the payment without the interest and penalties? Why would they do that? and that's why I said some people just have to think. That's with anything. Even if myself, if I loan money, the wealth in me lending is the interest rate that I'm going to add on to it. So a lot of times when people are behind when it comes to their credit, whether it's from a credit card, a lending institution, a finance bank, um, it is always the interest and penalties that people can't seem to put their head above water, because the interest and the penalties is what really suffocates the debt. So with that being said, when lenders lend money out to individuals, they lend it based on a percentage. And and whenever and you may not know this, but when you sign credit card application, a lending application or whatever, that lender has a interest rate on there, along with a rate in terms of penalty in the event that you pay late or what have you. And that is where a lot of that money comes from. So when that money comes, whether it's, the payment for the interest, a portion of the principal payment, it goes into what is on the financial statements. Now I'm talking in the income statement. That is income to the company. So when a person is paying and they are paying on time, that's all income in money to the bank. Because if you look at a bank financial statements, there is going to be a line item on the asset side of the balance sheet that is going to show what the amount of money they have lent out to institutions, individuals, or what have you. And it's not going to clearly be put on the financial statements as credit card, credit card lending. And I guess I should have brought up Bank of America's or Chase or what have you financial statements, because it's public information. They're publicly traded companies, and to really look at what that line item is on their financials. But with that being said, that is why when I talk about not all debt is created equal, and I talk about the relationship between the original creditor, the individual who issued you credit, and the debt collector. That's why I said, if you want to master this area of credit, you have to understand how the monetary system is set up, because it's bigger than you just looking at one thing. Credit is the monetary system in at whole. And that's why I've said in the past, I've said it in my book, I explain it in my book, so people can understand the relationship between original creditors, debt collectors. Bank of America in this case would be an original creditor. Those individuals, customers, institutions that pay these companies on time, those individuals are assets to Bank of America. They're not liabilities. They don't become liabilities until you default on that loan. But it's truly not a real liability in a sense, because they sell that information off. So when they sell that information off, even though it may be a liability for a short term, I don't even think it's a long term line item in a balance sheet, but it's on a short term basis. When they sell it off to a debt collector or a debt buyer, they get income again. So they sell it off and they're still making money. So understand, these institutions understand their financial statements. Many individuals, they don't understand their financial statements. So I ask you this. So if you're one of those individuals who've said, I'm going to use credit cards as a way for me to get into this cryptocurrency space, my thing is this: what do your financials look like? what assets do you either you've created or you've purchased that is bringing income in? Because just because you make that investment into that cryptocurrency doesn't mean that it's going to be automatic income to you, especially if you're banking on the price of it rising, because now you're looking at appreciation. You're looking at that if I put money into this cryptocurrency and the price rises and I cash out, okay, then the income on my financial statements can rise. But I say this, the fact that these lending institutions understand their financial statements, they are not going to put themselves in a risk, because they know that if a person has to go to their credit card as a means of leverage to invest in a new form of commodity, it's a good chance they don't have no money. So if they don't have no money to make the investment outright, and they have to go to their credit cards, in the event that the cryptocurrency price tanks or what have you, we may not get our money back, because now they're so over leveraged because they've used their credit cards and now they've invested it in a commodity, of a cryptocurrency that has now tanked. And so this is not a play on words. It's math. Like, people lie, but numbers don't lie. And when you look at the numbers, understanding, that's why I said, do you understand your financial statements? Because they understand theirs. They understand. That's what I said. This is not a video on if you should invest in cryptocurrency or not. It is primarily a video in terms of credit. And so that is all I have to say on this matter. I am doing this video live. Um, and so, like I said, if you want to read the rest of this article, I will put the links below. Also, if you are interested in anything, I will be having a further discussion about this matter tonight. I do, like I said, a live class on Mondays, private class, not here on YouTube, private class, and we will be talking. This is the credit to cash flow class that I've talked about a lot in 2017. We've moved over to 2018, and we're going to be discussing these things about over leveraging yourself, understanding your financial statements, and understanding the monetary system at whole, because credit is so much bigger than I need to get some credit, or I need to improve my credit score. It's much bigger than that. So once again, this is Aurelia. All my information will be under this video, and I look forward to talking to you in the next video. Thank you.